Welcome back to Boring Currency. Do you recall when they dismissed silver as a mere novelty? When the talking heads on financial news channels declared it a stagnant asset, merely accumulating dust in secure storage? Remember when your investment advisor scoffed at your decision to acquire bulk silver, contrasting it with shares in tech giants like Nvidia? Well, the laughter has long since ceased. It is now January 19th, 2026. And if you possess physical silver, you are experiencing an exceptionally prosperous day. We have just received the initial figures from the global marketplaces, and the outcome is definitive. The valuation of silver has not simply surged, it has ascended vertically. Spot silver has just achieved a record-breaking peak of $94.30. Let us pause for a moment to truly grasp that figure. $94. We commenced the year at approximately $71. It has been precisely 19 days since the revelry in Times Square concluded. In these 19 days, silver's value has appreciated by 31%. 31% in under 3 weeks. If you were to project that growth on an annual basis, the figures would exceed the capacity of any calculating device. This is no longer a typical bull market. This represents a dramatic escalation. It is a currency devaluation masquerading as a price surge. We are outperforming Bitcoin. We are outperforming the S&P 500. We are outperforming the group of 7 prominent technology companies. The most unexciting asset on the planet has abruptly transformed into the most sought-after investment on Wall Street. And the most remarkable aspect, the mainstream media is still grappling with how to report on it. They are in disarray. I encountered a headline suggesting silver's ascent was attributable to speculative trading activity. Speculative activity. When an asset appreciates by 31% in 19 days, that is not speculation. That is sheer panic. That is capital making a frantic escape from a collapsing structure, attempting to squeeze through a narrow portal labeled tangible assets. The climb to $94 validates every assertion we have made on this platform over the past year. It confirms the tariff predicament we examined yesterday. The market comprehends that the silver supply within the United States is constrained. It acknowledges that the London storage facilities are inaccessible. Consequently, the price in the US is escalating to reflect the global reality. It validates the sovereign default experienced by the US Mint. The inability to procure eagles directly from the government has compelled billions of dollars in retail investment capital into the immediate market, effectively acting as propellant for the price. But most critically, it validates the physical constraints of scarcity. Observe the accompanying chart. The progression from $90 to $94 occurred within a single trading session. We gained nearly 5% overnight. This is precisely what transpires when no sellers remain available. Consider this. Who is selling silver at $90? Are the mining operations selling? No. They are withholding supply, anticipating $100, or they have already divested their holdings through private transactions with entities like Samsung. Are the individual investors selling? No, they are acquiring. They harbor significant concerns about inflation. Are the financial institutions selling? Our preceding analysis concluded that the banks have conceded they are shifting their stance. They are purchasing to cover their short positions. Thus, we are witnessing a market characterized by inelastic demand and virtually non-existent supply. In the realm of economics, when demand and supply both exhibit vertical trajectories, the price approaches infinity. We are observing the initial indications of a hypermonetization event. Silver is undergoing a revaluation, transitioning in real time from an industrial commodity to a monetary reserve asset. At $94, silver is no longer merely a component in solar panels. It has become a currency. It is a repository of wealth comparable to gold. And speaking of gold, observe the yellow metal. It is currently trading near $4,630. It is maintaining its position, but silver is advancing more rapidly. The gold to silver ratio is contracting. It has fallen from nearly 60 to 1 to approximately 49 to 1 within a matter of weeks. This compression of the ratio is the driving force behind the wealth redistribution. It signifies that silver is acquiring purchasing power at a faster rate than gold. It means that the asset often referred to as the poor man's gold is now rendering its holders wealthy. However, I must pause here momentarily. I wish to introduce a measure of grounded perspective amidst this wave of excitement. Because when you witness a chart exhibiting parabolic growth and your personal wealth experiences a 30% increase in a single month, the natural human inclination is to succumb to avarice. You begin to perform mental calculations, multiplying $94 by 10,000 ounces. Cease. This is precisely where the peril lies. A market experiencing such rapid ascent is inherently volatile. When an asset appreciates at this velocity, it attracts undesirable attention, it attracts speculative capital, it attracts individuals who engage in leverage trading, borrowing funds to acquire positions they cannot truly afford. And as we will elaborate upon later in this comprehensive analysis, the financial institutions are observing this leverage. They are anticipating an opportunity. They recognize that the higher the paper price escalates, the simpler it becomes to engineer a dramatic downturn. We reached $94 today. That is an undeniable fact. However, do not presume that tomorrow we will ascend to $98 and then to $100 on Wednesday in an uninterrupted trajectory. The path to triple digits is paved with considerable fluctuations. Nevertheless, a new factor has emerged in the market today, suggesting that this instance might indeed be different. A new class of buyer has entered the arena, possessing greater financial resources than the banks and a more pressing need than the general public. We have discussed solar energy, we have discussed electric vehicles, but today, analysts are finally beginning to acknowledge the surge in demand driven by artificial intelligence. In the subsequent segment of this detailed examination, we will explore the confluence of artificial intelligence and silver. We will elucidate why the enormous data centers being constructed by Microsoft, Google, and Amazon are transforming into veritable black holes for silver. We will explain why the artificial intelligence revolution is inextricably linked to a silver shortage. This is the fundamental driver that distinguishes this rally from those of 1980 or 2011. In those periods, silver was primarily viewed as a monetary instrument. Today, silver represents the critical infrastructure of the future. We stand at $94. The prevailing winds are in our favor. The financial institutions are in retreat, but the conflict is far from over. It is merely entering a new, more unpredictable phase. We must address a fundamental inquiry. Why now? Why, after 4 decades of stagnation, has silver suddenly awakened and surged to $94? The skeptics will dismiss this as a mere bubble, a product of speculative fervor. However, they are overlooking the most significant structural transformation in the global economy since the advent of the internet. We have extensively discussed solar panels. We are aware that the photovoltaic industry consumes over 20% of the annual silver supply. That was the initial impetus. We know that an electric vehicle utilizes 3 times the amount of silver as a conventional gasoline-powered automobile. That was the second impetus. But today, a third, more potent force is coming online, and this force is larger, faster, and more insatiable than the first two combined. I am referring to artificial intelligence. Now, typically, when individuals discuss artificial intelligence, they focus on software. They speak of ChatGPT, of coding. They overlook the fact that software does not exist in isolation. It operates on hardware. It resides within vast data centers filled with countless servers, intricate cabling, and billions of microchips. And the fundamental principles governing that hardware are immutable. Artificial intelligence necessitates speed. It demands zero latency. When you task a computer with replicating human cognitive processes, the electrical signals must traverse instantaneously. There is only one element on the periodic table that facilitates the movement of electricity more efficiently than any other. It is not copper, it is not gold, it is silver. Silver is the most conductive metal known to humanity. In the domain of high-performance computing, silver is not a mere option, it is an imperative. One cannot fabricate a cutting-edge NVIDIA chip or a high-speed server connection using copper. Copper is too sluggish. Copper generates excessive heat. Silver functions as the cooling agent of the digital era. It enables these immense supercomputers to operate without succumbing to thermal overload. We are currently witnessing a substantial expansion of AI data centers across the United States, Europe, and Asia. Microsoft, Google, and Amazon are allocating hundreds of billions of dollars to construct the infrastructure of tomorrow. Each of these data centers represents a voracious consumer of silver. Silver is integral to the electrical contacts, the soldering processes, the switching mechanisms, and the semiconductor packaging. The analysts on Wall Street have yet to update their financial models. They continue to project silver demand based on jewelry and tableware consumption. They have failed to incorporate the AI premium. They remain unaware that the very fabric of the cloud is interwoven with silver. However, before we delve deeper into the mechanics of this demand surge, I must briefly address a critical matter. We are boring currency. This is the original platform. We are genuine individuals conducting meticulous research. Unfortunately, we have observed a proliferation of imitative channels. They are employing our distinct visual identifier. They are replicating our scripts verbatim. They are disseminating our video content on platforms like Twitter, posing as us. Let me be unequivocally clear. We operate solely on this YouTube channel. We do not maintain a Twitter presence under an alternate designation. We do not engage in cryptocurrency sales on Telegram. The other entities utilizing this visual marker are not affiliated with us in any capacity. They are opportunistic imitators seeking to reap rewards without undertaking the foundational work. We deliver this video content with extensive research and exclusively verified information out of respect for your time and intellect. Therefore, if you value the effort we invest here, please assist us in safeguarding this community. Proceed to the comments section immediately and type "staying with the original." Inform the algorithm that your interest lies in genuine analysis, not a superficial imitation. Now let us return to the AI demand surge. The reason this emerging source of demand is so fundamentally bullish stems from the identity of the purchases. When a jewelry manufacturer procures silver, their purchasing decisions are relatively insensitive to price fluctuations. However, consider the major technology corporations such as Microsoft or Apple. These entities possess vast reserves of capital exceeding the gross domestic product of numerous nations. If Microsoft is embarking on the construction of a $10 billion data center, does Microsoft concern itself with a doubling of the silver price? No. The cost of the silver represents a negligible fraction of the project's overall expenditure. But, and this is the crucial point, the project cannot function without the silver. This renders their demand perfectly inelastic. They will procure it at any cost, literally any cost. If silver were to reach $500 per ounce tomorrow, Google would still acquire it, as the alternative would be to discontinue their artificial intelligence division and forfeit their position in the race for future dominance. We are witnessing a convergence of the silver shortage and the artificial intelligence arms race. The technology titans are becoming acutely aware of the fragility within the supply chain. They recall the semiconductor scarcity experienced in 2020. They understand that the concept of just-in-time delivery is largely an illusion. So, what actions are they taking? They are circumventing the traditional intermediaries. We have received reports suggesting that technology firms are entering into direct offtake agreements with metal refiners. They are securing their metal supply before it even reaches the open market. This provides an explanation for the depletion of physical silver reserves held in vaults even as the price escalates. The metal is not flowing to investors. It is being channeled into the strategic stockpiles of Silicon Valley. This introduces a novel dimension of scarcity that was absent in 1980 or 2011. In those eras, silver was primarily considered a currency. Today, silver is synonymous with technology. A newly constructed data center cannot be readily recycled. That silver is sequestered for a period of 10 to 20 years, effectively removed from the circulating supply. Consequently, we have solar power consuming 20% of the supply, electric vehicles utilizing an additional 10 to 15%, and now artificial intelligence entering the equation, potentially demanding another 10%. Perform the calculation. That amounts to 45% of the global silver supply consumed by just these three industries. This leaves very little for jewelry and virtually nothing for investment bars and coins. Yet investment demand is at an all-time high. We have observed consistent inflows into silver-backed exchange-traded funds with 169 consecutive days of net purchases. There are simply too many participants vying for an insufficient quantity of the asset. The surge in AI-driven demand acts as a turbocharger for this existing dynamic. It ensures that even if demand driven by monetary considerations were to plateau, industrial demand will continue to propel the price upward. This is precisely why the breakout to $94 is sustainable. It is underpinned by tangible necessity. The financial institutions can continue their paper-based manipulations, but they cannot conjure silver for Microsoft. Ultimately, the industrial consumer will emerge and assert their demand for the metal. And when the industrial consumer appears, the price discovery mechanism will shift from speculative assessment to outright desperation. We are now entering the phase of industrial desperation. Re-examine the chart. That vertical surge to $94. That is the audible manifestation of a market comprehending that there is insufficient metal available to construct the future that has been presented to us. Celebrate the $94 mark. You were correct. You were early. However, do not become complacent. The fact that the fundamental underpinnings are robust does not guarantee a smooth trajectory. The financial institutions are akin to wounded predators. They have relinquished control of the overarching trend, but they still possess formidable capabilities. They still employ sophisticated algorithms, and they retain the capacity to engineer significant price volatility. In the forthcoming segment of this comprehensive analysis, we will examine historical instances of aggression. We must temper this enthusiasm with a serious cautionary note. We need to review what transpired on December 29th and January 8th. We will analyze the patterns associated with bank-induced traps because historical precedent indicates that every time silver achieves a new record, the established powers launch a counteroffensive. If you were to increase your leverage at $94, assuming a linear ascent, you would be walking directly into a kill zone. The demand from artificial intelligence guarantees the ultimate destination is higher prices. However, the financial institutions dictate the path we traverse, and that path is riddled with obstacles. The technology is revolutionizing the world. Silver is powering that technology, and you hold the keys to this transformation, but ensure your safety harness is secured. The period of turbulence is only just commencing. The financial institutions are regrouping. Are you adequately prepared? We have dissected the AI demand shock, but now it is imperative to engage in a serious discussion. We must reduce the ambient noise, set aside the celebratory beverages, and examine the current landscape with a clear, unclouded perspective. Because while the upward trend is undeniable, the journey ahead is fraught with peril. I understand precisely how you feel at this moment. You glance at the screen, you observe the green price candles, you feel invincible, and you envision a direct ascent to $150. That sensation, that unbridled euphoria, is precisely what the financial institutions are anticipating. They desire for you to become overly confident. They want you to log into your trading account and maximize your margin usage. They hope for you to place your entire investment on the absolute peak of the price chart. Why? Because when you are operating with leverage, you become vulnerable. When you are leveraged, they can target you. We must learn from past instances of aggressive market manipulation, because if you disregard history, you are destined to repeat those costly errors with your accumulated savings. Let us revisit December 29th, 2025. We had just surpassed the $80 threshold. The prevailing market sentiment was precisely analogous to the present situation. Everyone was confidently predicting $100, and then the trap was sprung. Within a single trading session, the financial institutions orchestrated a 16% collapse. They drove the price from $83 all the way down to $70. It was devastating. It was swift. And it resulted in the vaporization of billions of dollars in retail capital. Those individuals who purchased at the breakout point using margin were liquidated. Their accounts were reduced to zero. Now, let us fast forward to January 8th, a mere 10 days later. The price had rebounded. We had returned to $82, The optimistic investors had regained confidence, and then it happened again. Another engineered sell-off, another market collapse. The price plummeted 12%, crashing down to $74. The headlines proclaimed a double top. The weekend saw further selling at the low point. And finally, consider last week, January 15th. We reached $93. The atmosphere was one of jubilant anticipation, and by lunchtime, we were trading at $86, a 7% decline within hours. Do you perceive the recurring pattern? Every time we achieve a new price high, the financial institutions initiate a counteroffensive. December 29th, a decline of 16%. January 8th, a drop of 12%. January 15th, a decrease of 7%. This is not random market fluctuation. This is a deliberate algorithmic strategy. This is a predator hunting its quarry. The financial institutions have direct access to the order book. They can precisely identify the location of your stop-loss orders. They know that if they depress the price by just $5, they will trigger a cascade of automated sell orders. They leverage your own financial instruments against you. They initiate the downward movement, and your stop-loss orders transform it into an avalanche. So here we are at $94, the highest valuation in history. The risk of a significant price correction is elevated today compared to yesterday. The more individuals who commit to the long side of the market, the easier it becomes to destabilize the position. I am conveying this information not to instill fear, but to provide protection. If you acquire a futures contract today at $94 and the financial institutions engineer a 10% correction, the price will fall to $84.60. If you are utilizing 10-to-1 leverage, a 10% price decrease will obliterate 100% of your equity. You will be eliminated. You will be out of the game. And the unfortunate reality is that the following day, the price will likely rebound to $100. The AI demand and the tariff trap will exert their influence, and the price will recover, but you will not be present to witness it. You will have been eliminated during the downturn. This is the vertical market trap. The financial institutions cannot indefinitely prevent the price from increasing in the long term, but they can still prevail in the short-term paper battles. They can still inflict maximum damage upon those individuals who perceive this as easy money. This is precisely why we consistently advocate for the acquisition of physical silver. Consider the investor who purchased physical silver on December 29th at $83. When the price declined to $70, did they receive a margin call? No. Did their silver vanish? No. They simply held their position. They waited. And today, they have realized a 13% gain. Physical silver is not subject to leverage. It does not have stop-loss orders. The financial institutions cannot target it. When you possess the physical metal, you are impervious to historical instances of market manipulation. A sudden price collapse in the derivatives market is merely a news headline to you. It does not impact your ownership. We are entering a week of heightened risk. The $94 level represents a target clearly visible on the back of the bull market. We anticipate an expansion in price volatility. We could observe fluctuations of $10 within a single day. Imagine awakening tomorrow to discover that silver has fallen by $8. Would you experience panic? If your answer is yes, then you have overextended your position. You are assuming excessive risk. The financial institutions are in a desperate situation. They face potential losses totaling $400 billion. They will resort to aggressive tactics. They desire your silver to cover their short positions. Do not fall victim to the trap. The overarching trend is upward. The ultimate destination is triple digits. However, the path from $94 to $100 will resemble navigating a minefield. We have reached our conclusion. You now comprehend the full significance of the current moment. The panorama is clear. The trend is unequivocally upward. The fundamental economic factors are exceptionally favorable. However, the system itself is compromised. How does one triumph in a rigged game? The answer is straightforward. You cease playing by their established rules. You withdraw your assets from the table. You depart the arena, and you never look back. This is the physical silver manifesto. For decades they deceived us. They persuaded the world that a piece of paper representing silver held the same value as physical silver itself. This was a fabrication. paper silver represents a commitment. Physical silver represents tangible ownership. In stable economic conditions, commitments are sufficient. During a crisis, commitments are abandoned. Observing the 31% surge in 19 days, it is evident that we are indeed in a crisis. Rule number 1, do not liquidate for fiat currency. I understand the temptation is overwhelming at this precise moment. You have achieved a 300% gain. But ask yourself, what will you acquire with that fiat currency? Will you entrust it to a financial institution that is technically insolvent? If you exchange your silver for dollars, you are trading a scarce asset for an infinitely expanding currency that is steadily losing its value. You are abandoning your lifeboat for a ticket back onto the doomed Titanic. The dollar is not the ultimate objective, it is itself a casualty. The appreciation of silver to $94 does not signify silver becoming expensive, it signifies the dollar's decline. Rule number 2, the ounces to acres strategy. You divest your silver only when you can exchange it for a cash-flowing tangible asset that can sustain your family. You trade ounces for acres. Historically, in 1980, it required approximately 800 ounces of silver to purchase an average home. Today, even at $94 per ounce, it necessitates approximately 4,500 ounces. We have not yet reached that point. The ratio must compress further. You must await the moment when you can enter a closing, present a substantial quantity of silver, and depart with the property deed. You are exchanging one form of generational wealth for another. Rule number 3, prepare for cash settlement. If you hold a futures contract or an exchange-traded fund and the price escalates to $150, the prospectus indicates they may opt for cash settlement. They will issue you a check and close your position. Subsequently, if you attempt to use that check to purchase physical silver from a dealer, you may discover that the market price has surged to $300. You will have been compensated in a currency that can no longer procure the asset you desire. This is why physical possession is the only viable manifesto. It cannot be subject to default. It is the sole asset devoid of counterparty risk. We stand at $94. The psychological pull of $100 is drawing us upward. All indicators point to continued appreciation. But understand, financial institutions are observing. They anticipate the peak of market excitement. They may attempt to force the price down to $88 to shake out hesitant investors. If such a scenario unfolds, do not lose hope. Do not succumb to fear. Examine your holdings. They remain intact. Their intrinsic value is unchanged. Their luster persists. A temporary price decline is an opportunity. It presents a final moment to trade depreciating fiat for valuable tangible assets before the cost becomes astronomical. The momentum is building, proceeding at 94 miles per hour. Maintain your conviction. Keep a close eye on traditional forms of money. The period of affordable silver is over. The phase of rapid appreciation has commenced. Do not allow them to sabotage your success. Remain vigilant and embrace the era of silver. Join us.